Well, welcome to our weekly High Rock video. It's great to be back after a break last week. If you're watching for the first time and are interested in learning more about High Rock, please visit our website at highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Today we are going to talk about our three asset models and any updates on developments in and around our tactical strategies, what we see happening in the global economy and financial markets, and other issues that are pertinent to the world of wealth management. Well, Paul, we always say that bonds lead other markets, and the yield curve in Canada continues to flatten. It's now at about 40 basis points between the 2-year bond and the 30-year bond, and it's been narrowing and flattening pretty much since most recently anyway, since early 2017. We're at the lowest point we've been at. What do you think this is telling us?
Well, I think a couple things. Number one, that inflation is not a concern because inflation is the number one enemy of longer bonds like 10-year and 30-year bonds. And number two, it tells us both in Canada and the U.S. that the central banks that are raising rates, Bank of Canada and the Federal Reserve in the U.S., may just be making a policy error by raising too much, too quickly, too fast, because every recession is preceded by the central banks doing so. And in fact, Scott, last week at one point during the day, 10-year and 30-year Government of Canada bonds were dead flat at 2.57%, and they've really, it's been a strong move to lower yields over the past week. Just as an example, 10-year Canadas are now down around 230, and 30-year Canada's at 234, just 4 basis points higher.
Right. So a lot of this obviously has to do with what's going on in Canada. Also, a political issue. We bring in oil prices. We'll talk about that in a minute. And NAFTA. All of these things adding a significant amount of uncertainty. And even we can throw in that there's a good likelihood of a rail strike for CP engineers and conductors. And I'm not sure what your opinion is on that coming forward, but that can't be positive for the Canadian economy, right?
No, I wouldn't think so. We've got enough transportation issues with hydrocarbons in this country.
Yeah,
we don't need it through grains and everything else.
So we've seen the Canadian dollar, and again, it's maintaining a downward trend that pretty much began back as the yield curve in the most recent real yield curve steepening, right? So making lower highs when it does jump up. But we've seen a fair bit of volatility in the last little while as well, and I've got to say that part of that is coming from oil prices, and as we said, also probably the fact that they couldn't get NAFTA resolved, and it looks like it's going to be pushed back. And we have some issues coming up with NAFTA with regards to Mexico too, because there's a Mexican election coming up in very shortly, and I think that puts some pressure on the timeline, right?
Yeah, for sure. And one of the things, well, two things, is the Canadian dollar is even weaker again this morning. But we do have an election in Ontario in just over a week as well that may be affecting the Canadian dollar, as the NDP have been rising in the polls over the past 2 weeks.
Right. Good point. Anything to say about oil prices and your thoughts there? Obviously, they've come off pretty significantly over the last 5 trading sessions.
Yeah, well, even over the last 2 or 3. Overall, the view was WTI, which is U.S. oil, was going to keep moving higher because Saudi Arabia, as I've mentioned before, wants to IPO part of Aramco, which is arguably the biggest company in the world. And they really wanted to do so, and I'm sure still want to do so at higher oil prices and get a better valuation for the company, for the shares that they're selling to the public. So that's why I think a large reason why oil prices bottomed out 2.5 years ago and have been moving higher ever since. Over the past couple of days, what we've seen is both Saudi Arabia and Russia stating that they may actually start pumping out more oil. So that's panicked everybody, especially after such a big, lofty move. So I think
This
that's
is really just taking advantage of the higher prices for each of those respective producing nations, right? I mean, they like the fact that prices are up. If they can get some deals selling it at these higher prices, it's a heck of a lot better than it was a year and a half ago.
for sure.
Yeah. Okay, let's talk about Italy a little bit because we've seen some political issues happening over there. Italian bonds have gotten extremely uh, volatile. And what are your comments? What are your thoughts?
Well, it's a strange situation in Italy. Um, Effectively, non-government uh, situation with the far left and the far right trying to form a government, and then the prime minister came out yesterday and effectively said it ain't going to happen. So I assume they're going to go back to the polls and have a full-on election, but I think there's just so much uncertainty. I mean, you can obviously looking at that chart, you can see how. My Siri just went off. You can see how the government, or the 10-year government bonds in Italy have responded. That is an enormous move, and just we don't have the chart in here, perhaps, but the other European government bond markets have actually done the opposite, where yields there's been a flight to quality, and yields have actually gone down in Germany, for instance.
Right, right, okay. And obviously, Italian stocks are showing volatility there as well, and it's just really all the uncertainty that surrounds the political and economic situation in Italy.
Yeah, that's probably. I mean, they're probably down about 10%, right?
Yeah, absolutely, absolutely. Well, we're lighter on a global scale in our equity holdings, and if this is a sign of things for Europe, then we know that emerging markets as well have been suffering a fair bit over the last little while, especially on a stronger U.S. dollar. Correct?
Yep.
All right. Finally, the U.S. yield curve. Not a significant amount of change over the last couple of weeks since we last talked. The U.S. Federal Reserve is still expected to raise interest rates at their June meeting, and there's not a lot new going on in the yield curve there. Is there anything that you're seeing that we should be aware of?
No, I think you pegged it. Really, not much has happened over the past week on U.S. Although we should add that U.S. yields just nominally have again similar to Canada have come down a little bit. So just as an example, 10-year U.S. Treasuries topped out around just over 310. I'm 311, 314, somewhere in there. Today they're at 293. So again, a bit of a flight to quality with what's going on in Italy, and we've had this North Korean meeting with the U.S. on, off, on, off. So that there has been for sure a flight to quality to high quality government bonds over the past week or so.
And the Bank of Canada meets Wednesday tomorrow, and we are not expecting, given all the uncertainties, not expecting to see any change in monetary policy from them, are we?
I wouldn't think so.
Yeah.
I think you pegged it in Canada, with NAFTA and potential rail strikes, and I don't think we're going to see anything from the bank.
Perfect. Okay. Well, that's great. Well, thanks everybody for tuning in. That's all we have for this week, and we certainly do appreciate feedback if you want to send some. Always like to know what you want to hear from us. So if you do have any feedback, please send it through. We'll be back next week with another version of our weekly video. But until then, we hope you have a great rest of the week and a wonderful weekend.